Welcome to Trading the Basics, and in this particular video we're going to be talking trading psychology. So without further ado, let's get into the presentation. So, why is psychology important in trading? To become a successful trader, psychology is important. In fact, it's absolutely critical. You need the right mentality to trade. It can influence you whether you make a profit, and it can also clarify why a certain trade didn't go as planned. The main objective of studying trading psychology is to ensure that you're familiar with a variety of issues which can in turn make your mindset negative. When you're aware of how to make decisions, not biased by your emotions, you will improve your prospect of achieving a profit or minimizing your loss. So did you know trading psychology will differ from person to person? It's determined by each person's mind and how they react to their emotions. Some people are more emotionally equipped for trading. However, this doesn't mean that those who aren't equipped can't learn to control their emotions. Emotions traders can experience that may affect their performance are the following: anger. We've all been there with revenge trading. I'm going to beat the market. Right. Fear. I don't want to lose £10. Or happiness. I'm really happy that I'm making shed loads of cash. But guess what? When you're not making shed loads of cash, you're not so happy. Hope. Well, we've all been there. Let's face it. I'm hoping the trade is going to go to the sky when actually it's tanking. Yeah? Right. That is hope. Impatience. We've all been there. Right? One of my most successful traders, when he first came on, he studied all our trading archives, and what he found is basically on a particular type of trade on the ES, if you stayed in it more than 15 minutes, it worked out and you got good returns. But if you just basically were impatient and exited quickly, then you wouldn't make money. Now, the fact is impatience is absolutely one of the killers when it comes to trading. So you gotta work on your patience. And then pride. We've all been there where basically we don't want to admit we're wrong, right? And we'll stay in a trade just to basically prove that we're right and the market's wrong. So, without further ado, let's move on. So how do we improve our trading psychology? You can improve your trading psychology by being aware of your own emotions, your personality, and trying to make impartial decisions. Only when you've accepted these can you put your trading plan into action and hope that they will have a positive effect on your decision making. Now, what I'm going to say is this, before I come on to the example. I am a Scorpio. That means I'm passionate and I'm emotional. I'm probably your worst type of person to become a successful trader. So what I'm saying here is if you know this, then you can work on this, right? Because I've overcome those emotions. I've overcome the issues that we've just spoken about. And if I can do it, you guys can do it. So a good example of an overconfident trader is taking more risks and allowing losses to run in the hopes that the market will turn round. We've all been there, including myself. Now, one of the things I actually did to combat this is I had two things. I'd put a daily loss limit in place on all my accounts. So basically, I could never blow my account in a day because I had a daily loss limit, and I recommend everyone do that. And obviously, when I come onto the stop loss trading video, I'm going to talk about that more in depth. And also, I split my accounts. I had multiple accounts. So if I'm trading one account, right, then obviously it's a percentage of your overall net accounts, and obviously you're risking less. Now, coming back onto the presentation, it's always better to cut your losses short. Behavior like this can lead to large losses or eventually collapse of your trading account. And yes, I have blown my trading accounts in the early days. And this is why I'm saying to you, this is why you need to use your stops to minimize your losses and make the decision when to close the trade before you've even placed it, i.e. your trade plan. And again, we're going to talk about trade plans in more detail in a separate video. By doing this, you can become aware of your own biases and have made a conscious decision not to act on them. Just in case you don't know what to stop, it's an order to buy or sell a stock when the price moves past a particular point. And again, we're going to have a specific video to talk about stops. So moving on, how do biases affect trading? Biases affect trading as by definition a predetermined personal disposition. As a result, you can hinder your decision making and cloud your judgment, leading you to act on a gut feeling rather than a fundamental or technical analysis, right? Now, just a point to note that obviously we follow the bots, right? The bots have taken me 7 years to develop and about 3 years in coding alone. They do a hell of a lot more analysis than I can do, and they don't have emotions. Now, the key reason I develop them is to help me combat my emotions in trading. So obviously when I see a signal, right, and my gut feeling, say for instance there's a buy signal on the system, but my gut feeling is the market's going to tank, I go with the trading signal because I've tested them, and statistics show that they are right. So obviously sometimes I do, like everyone else, have gut feelings, and those gut feelings tend to be wrong. So trading bias means that you could be more likely to trade an asset that you had a past success on, as an example. Avoid an asset where you've had a loss. Now, one of the things we actually do, as you know, we only trade the Qs, or the NQ or the ES. We're pretty specific in what we trade, because I'm a true believer in jack of all trades, master of none. So the point here is basically is we don't have that issue because we stick with particular assets. So let's go on to the 5 types of bias. Well, representative bias. Representative bias means that you adhere to or are more likely to recreate trades based on previous successful trades. Now, I'll tell you now, because I've been trading now for over 30 years, I learn something every day, and that's one of the reasons I'm in trading, because I find it very interesting, and I also find it challenging. So my point is this, is the market has changed year on year. What would work, say for instance last year, doesn't necessarily mean it's going to work this year. And obviously you do have seasonal trading where what would, for instance, work in September may not work in May. So representative bias is quite important, that you are aware of how the markets work, and we will dive deeper into that in the part 2. Now, status quo bias is when you pursue old strategies or trades when you should be investigating new options. Well, that follows on from the representative bias, because at the end of the day, if you've got a particular trade that worked, for, say for instance, for the last 3 months and it suddenly stops working, then you need to investigate why. Now, a key point here is you should be journaling, and you should be able to identify that when you're journaling. Now, confirmation bias, we've all been there when we first start out as traders. We look for that special indicator, that magic indicator that's going to be right all the time. It just does not exist. There is no trading system that's going to work 100% of the time. So what you tend to do is you start with one indicator, MACD, and then you stick a few moving averages on, then you stick a stochastic RSI, and before you know it, you've got that many different confirmations that you end up that when you do get a signal, it's too far gone. And also, you use news and analysis to prove your pre-planned ideas. And what I basically mean by that is for instance, you're bearish on the market, and then you hear about a recession. Well, the fact of the matter is if you'd known the following year that we were going to be in recession, and you'd used that information, i.e. you, for instance, thought the market was going to go down, you'd be on a loser, right? So the markets don't always follow what's going on in the news. Now, gambler's fallacy is when you presume that an asset has increased and is going to continue to increase. Now, we've all been there where we've thought, you know what, this is going to go to the moon. In fact, some of my biggest losses have been because of this. I've said, no, it's going to be going to the moon, and it's not. Now, you can end up losing a lot of money here, and I'm just going to talk to you about a particular instance where this happened to me. So we were in a penny stock, and this is back when I was 22, so it's a fair old time ago, 28 years ago now. And we bought this particular penny stock, and we thought it was even a penny. It was like 20, effectively a 20th of 1 pence. Now, this particular stock, Pacific Media, was one of the first potential internet banks, and it was looking potentially good. They had some really good guys involved, including Richard Worthington at the time, and it went to 20 pence. Now, obviously, that's not a 10x scenario, that's a 100x scenario. Now, at the time, both me and my mate who was trading thought it was going to go to the sky. We actually thought it was going to go to £1, right? And literally the following day, when it had jumped to 20 pence, the following day they announced that it wasn't going to get its banking license, and it tanked, and they ended up delisting the stock, and we lost the whole lot. So the point of this story is this: it don't always go up, right? And at the end of the day, just be aware of that. Look at your profits, look at your trading plan, and look at where it could potentially go to, i.e. where we think it's where we think it's going to top out. So, negativity bias, the final one on the list. Well, we've all been there, right, when we only see the negative side of a particular trade, and you could have made a slight adjustment to make a profit, so to speak. So, obviously, if you are negative, say for instance, you think the market's going to tank when actually we're in a bull market, then that's going to affect you. You're going to get eaten alive. So that's obviously the opposite to the one above, basically. So it is really important that you are aware of these 5 types of bias, and we are going to delve deep further on part 2 into these. So moving on, we've got some tips on the basics series to get you going with helping you with your psychology. Stop seeking perfection, right? Stop looking for that special holy grail trading strategy. It doesn't exist. There is no perfect trading strategy that will work every time. Focus on making you profitable and consistent. I bark on about becoming consistent and profitable because that's what's really important in trading. Right, every trading system has losing trades, right? And you know, there is no business in the world that doesn't have a cost, right? If it's a greengrocer's, it's the cost of buying your potatoes and carrots and so on, and marketing and paying for your staff, right? In trading, it's a cost of being in the market, i.e. taking a trade and actually taking a feeler trade, and sometimes it doesn't work. Now, that is priceless because you gain real good information. And I gain more information from my losing trades than I do from my winning trades. So it's just a point to know. Don't be ruled by fear. Not wanting to lose can cause you not to trade. And you never take any risks. Taking risks is vital for successful trading. Don't let your fears hold you back. Now, I'll give you an example of a particular student that has this issue. They end up, the market pops up a little bit, and then it goes down, and then suddenly they're in a little bit of a loss, and they take they take that trade and take it off, and they end up with a small loss. And then they consistently end up with small losses. Well, guess what small losses make? It makes one big loss, and guess what happens? You blow your account. So the fact is you've got to let a trade breathe, right? You've got to realise that a trade oscillates. We know on the ES that it oscillates by about 8 points. We know on the NQ it oscillates by 40 points. That means basically at any point it can go up or down by 40 points. So you're never always going to time your perfect entry. Now, obviously what we aim for to get around that, as an example, we have the range detection bot, and that obviously then identifies when we're in a range, and obviously when we're in the bottom of the range we can look at buying, and obviously when we're looking at in the top of the range we can look at selling. So we do want to get an edge, and that's how the bots helps us with the psychology side, gaining an edge. So develop your own opinions. Stop asking for other opinions and predictions. Learn how to fish rather than buying the fish. So basically what I mean by that is if you have you take the daily analysis that we give out every day and you develop your opinion from that, then you have an idea as to where the market's going, where it's been, how much it can move up, how much it can move down. Now, use entry and exit signals. Have a trading strategy. Now, obviously, we've got a trading strategy with the bots, but what my point here is basically not every single bot will suit you as well, right? For instance, the overnight trade bots, you might be suited to those types of trade as against the fast order flow bots, right? So develop your trading strategy and make sure you know when you should be entering and exiting. Now, don't use your emotions for entering and exiting. Do so on price action alone. Never trade on emotions. Now, we've all been there, including myself, right? Rather than trading your emotions, right, use the trading systems, i.e. use the bots, right? Be aware of what the bots are saying or doing, right? Be aware of the alerts, right? Most importantly, never hold on to a losing trade, even if you think it's going to go back. Because when your plan is telling you to exit, then do so. Because if not, it could end up in a big loss. And we don't want that. Now, remember what I always say, yeah? Right, before I'm talking about taking breaks. On a trade, we want an outcome of 4 potentials. A small loss, small gain, break even, or a big gain. We never want a big loss. And this is why we need to control our emotions. Now look, if you suffer a drawdown, which we all do, take a break from trading or change the market you're in, right? You will feel better, trust me. Now we don't just trade obviously the Qs, we do trade the ES and we do trade the Dow as an example. Dow's a little bit more slower in comparison to the NQ, and the ES is slower than the Russell as an example, right? So choose the market that you want to be in. That's also potentially helpful. Stay positive. Keep a positive mindset. I know it sounds basic to this, but always focus on the future rather than your present setbacks. If it becomes too much, step away from the charts. Just take a break. Take a break for a week. Right? Trading's never going to go away. It's always there. Right? But when you're in front of those charts, you need to be positive. You need to be not clouded by your current situation, i.e., have I had a losing streak? Right? Everyone has a losing streak. I have had losing streaks. Right? The fact is what I say to people is this. Right? What's really important is that whether you're green at the end of the month and green at the end of the week, right? The fact of the matter is this is when I'm talking day trading, right? Obviously, swing trading is different, right? The fact of the matter is basically we can be red for a number of consecutive trades on a day, right? But we want to aim for being green on the end of the day. Now, the fact is this. I look at trading as a Premiership football team. You can have Manchester United. They can be 3-0 down and right at the last minute they can come back and win 4-3. Well, that's a little bit like trading, right? If you take each trade, remain positive when you lose, right? But if it gets too much, then you do have to step away, right? But the fact is when I'm saying that, I'm saying if you're just consistently losing every single day. But personally, if you're consistently losing every day, you shouldn't be trading live money, right? Because that means you don't understand the trading strategy in the first place. And obviously that's a separate video from that point of view. And I would say basically what you should also be doing there in that instance, you should, and I know I'm diversing here, you should be proving the strategy first before getting into the trading. So, i.e. with live money. So, moving back to the presentation. Let's talk about 7 tips that I think are going to make a difference. Recognize your personality traits. Mark down your weaknesses. Put it on your trade plan, right? Question yourself. Am I holding this trade too long, right? You can always have a potential alarm. So it's as in a time alarm on a trade. So basically, after 1 hour, are we losing, or have you actually executed your trade plan, right? Have you actually executed your stop? Are you doing what you're supposed to be doing? So you've got to think about how you're going to work around these. Devise and follow your trade plan, right? Creating your trade plan is critical. If you fail to plan, you're going to plan to fail. I spent years fine-tuning our trade plans for ScreenShare. I've spent years developing that daily trade plan, i.e. what I think is going to happen and my theses as to what's going to happen, i.e. in this instance, we're going to go up to 50.80. We're going to do a rebid. If we do a rebid, then I'm interested in getting long as an example, right? It takes time to do these plans, right? Now, they're absolutely a waste of time and they're useless if you don't follow them. So obviously, if you see, for instance, the daily trade plan that we put out daily, and obviously the weekly trade plan, and then the auto plans, and you completely ignore them, well, to be perfectly honest, you're wasting your money. So obviously, it's just something to bear in mind. Right, be patient. Now, as I mentioned, Daniel earlier on, that had analysed the trades and that they were working out if they were held over 5 minutes. This man is probably the most successful investor in the world. The stock market is a wonderfully efficient mechanism for transferring wealth from the impatient to the patient, and that's Warren Buffett. So, listen to the wise. Be flexible. When you need to adopt your plan, just do it. And obviously that's a Nike saying. After a loss has incurred, take a break. Go and have a coffee. Or a chamomile tea if you want to relax. I have a rule for this. After 3 losses, I stop trading for the day or switch markets. Because the fact is that if I take 3 losses in a row, right, and just talking out loud here, not from the point of view of the bots, if I personally take 3 discretionary losses in a row, that means I am not in tune with the markets, right? Or just as an example, I take a bot trade, and then I take a trade myself, and it goes wrong. Then the fact is basically I'm out of tune with the markets, and that does happen. Right, receive your winnings. Many a times I've seen people on ScreenShare, price goes up, option goes up to 100%. They don't pay themselves on the push, and I do bark about paying yourself on the push, right? And then it comes straight back down, and they end up losing, right? Just because it didn't hit the target, I'm going to take 100%. I want 100% profits, and it goes to 80% and then starts reversing. Well, just take your profits. Don't let the market take it back. You're not right. The market will give you what it wants to give you, not what you want. And remember what I've always said. The only thing you can control is not how much money you make, it's how much money you lose. So, if you're up 80%, and it looks like it's turning, take your money. Retain a trading log. Now, look, I can't stress to you how important this is. Right now, even if it is a notepad or an Excel spreadsheet, now we recommend Edgewonk, right? But if it's an Excel spreadsheet, fine, that's great. If it's a notes and it works for you, fine, that's great. But you need to review it so that you know where you're going wrong. Okay, so this brings us to the end of the Trading the Basics series in psychology. Be sure to look out for the deep dive one, which will be out within the next few weeks. And also be sure to check out the other Trading in the Basics series, which are also coming out within the next few weeks. Bye for now. Remember, trade safely.